the 6th Board of Finance budget hearing for fiscal 24-25 budget. The primary purpose of tonight's meeting is to review certain follow-up questions on budget items that were discussed previously. In addition, we'll review a couple of departments that were deferred from earlier meetings. April 1, we have a public executive session scheduled that will allow each board member an opportunity to discuss their views on the budget, followed by a vote on April 3rd. We encourage residents to send comments and questions at any time to bof@ct.org. If you write to the board, please include your name and address for the record. Residents have been invited to provide live public comment at each of our previous 5 meetings, and they also do so tonight for budget topics that are on the agenda. Live public comment will be called for before item 3 is heard, whether attending in person or via WebEx. And we ask that comments be limited to 3 minutes per person. If you are on the WebEx this evening and want to provide public comment on any of the topics listed on tonight's agenda, please put your name in the chat box now, and you will be recognized shortly. There will also be a budget hearing on Saturday morning, March 30th, 9:30 a.m. at Fairfield High School. That is an in-person meeting only, and it's an opportunity for residents to share their input on any aspect of the budget. All right, so with that, we will move to item 3, discussion on the following budgets and follow-up items. Details of those items are listed. I won't read them all. They are listed on the agenda. For members of the public, any references to the budget book tonight are referring to the budget book that is posted online. It was, the book was not posted in this meeting's backup, but it's been posted a number of times for the Board of Selectmen budget meetings and the previous Board of Finance meetings, including last week. So if we refer to the budget book, we're page printed on the hard copy of the book in the upper right-hand corner. We'll also be reviewing additional backup documents that are posted online for follow-up items tonight. And for those, I'll reference the PDF page numbers on the backup. One last note about the posted materials, the backup materials. If members of the public have listened to previous meetings, you may have heard us reference from time to time a Google Sheet where board members include questions about the budget and get responses, including for items that are small or don't require discussion in our meetings. That Google Sheet with all of the Q&A is included in tonight's posted backup, and it's available if any member of the public wants to review the Q&A that originated from board members or any of the attachments that were provided to address the Q&A. So with that, do we have any members of the public on WebEx? Don't see any. Right. Right, so seeing none, we can move to the items that are listed on the agenda. So we'll try to go in the order that's listed here. We did have FairTV in here, and they've asked if they could speak first. Not sure. Is that someone from FairTV here?
Yeah.
Okay, and I just want to ask everyone if you could please, so we have the multi-directional microphones in this room and all the background noise gets picked up. So if everyone can just please be aware of that. All right, so let's start with FairTV, which is on page 47 of the budget book. Welcome. If you guys want to introduce yourselves and maybe take us through the quick highlights of your budget.
Luke, do you want to go?
Yeah, I'll start off. Hi guys, I'm Luke Altieri. I'm the production manager at over at FairTV. Thanks for having us on. Lee?
And I'm Lee Camlett. I'm a member of the commission.
All right, so I guess I'll start, just kind of highlight the budget. As you can see, it's pretty much similar to last year. This is my first year doing it, so the manager fee is lowered than what Jerry was making beforehand. So you see the decrease in 15 grand. The freelance labor went up this year just because more meetings. We've taken on probably, I would say, almost double the amount of meetings with the new Zoom room features and all the new equipment that we have that allows us to basically cover more meetings with less setup and breakdown and all that. So along with that comes more meetings, hence more freelance labor. Also, one other note that we had, Jerry was the old manager. He would attend a lot of the meetings and run them occasionally. So that kind of, since I'm not able to run as many, that kind of ties more into freelance labor charges. There was a decrease in the web stream, the virtual desk, those zeroed out. One note that's a little bit higher this year is the broadcast server. Currently, that's pending a grant to pay for all that. We're hoping to hear from them in April on the final decision on the grant and see if we have enough money to cover that. If that's the case, then we can scratch that item off the final budget of us if the grant covers it completely. But the server that we have now is out of date, out of warranty, and it's it's discontinued by the manufacturer. So it's security risk, so it definitely needs to be replaced this year. So that's why I put it in there for the additional charge this year. So that's kind of a quick summary of it. I know there was a few questions about it, so I'd be happy to answer any questions that you guys have regarding it.
All right, well, thank you for that summary. Thank you for being here. Mr. Mottola?
Yeah, I'm the, you can blame me for calling you here tonight. I didn't really have questions on your budget. Yeah, but thanks for telling us about possibly not needing $30,000. You'll know more about that in April, you think, the grant?
Yeah, so the final meeting for the grant is the PEG-PISA grant. That should be, I believe, beginning of April is the final decision. So we should hear a final decision by then, and then we'll know whether to adjust the budget. Of course, obviously, if it comes after the final budget goes through, then there's not much we can do. But I believe that we should hear before the final budget.
Okay, so you, in our backup, this is page 13 for the public. You gave an update to Frank, and you kind of answered my question, but I just wanted to make sure the public understood. My big concern, I've been doing this for a long time, Board of Education, Board of Finance, and I just really noticed that the quality of the production at the Board of Ed site,
Yeah.
watched on TV, isn't really good. And I think you answered my question. Can you just tell the public what's going on with respect to that? And then my follow-up question to that would be, you said that this is something that has to be the Board of Ed boardroom, the Zoom room. Zoom room isn't complete yet, so people may notice there is one wide angle shot instead of 2 or 3. That's the issue a lot of us are having. What's the process to fix the Board of Ed room? And is that money that FairTV needs to do that, or is that a Board of Ed issue?
So that, to my understanding, that is a grant that the town received. That's the same. So they decided to pick a vendor that did the installs at Board of Ed, the one at Fire Training Station, Fire Training School now, as well as the Board of Sullivan Hall and Old Town Hall. It's the same vendor that did all the locations for the Zoom rooms. There was a equipment issue with the one at Board of Ed. So they basically installed it. It wasn't working properly. So they had to reorder more equipment to be able to finish it. I'm not sure if it was back ordered or what, but again, that's something that the Board of Education IT department and the town IT department are kind of working side by side to get that squared away with the vendor.
Okay. That's
again,
not your issue then. you're
That's
saying.
not our issue. Again,
That's
this is something that to my understanding, it's a grant that was sent to the town of Fairfield. So we have no control over it. We had no input, to my understanding. So it's something that we're kind of just rolling with the punches, and that's why we have the one camera there, because originally we had equipment there. We had to move it out so they could set up the new equipment, but that equipment's not working yet from the vendor. So we just kind of set up a temporary shot. To, our knowledge, it was going to be a couple of weeks. Turned out to be more than that. But I can say that I heard that they might possibly be coming out April break to finish that or continue working on it. So there's hope that it should be completed in the near future.
All right, you answered my question. Thank you very much.
Yeah, and again, just want to reiterate that once it's done, you should see the multi-angle zooms, kind of like you saw with the Board of Selectmen budget meetings, where you had the two angles, more zoomed in on the people, a little bit, better video quality, audio quality. So hopefully once that's done, you should kind of be liking the results.
Thank you, Luke. I appreciate it.
Yeah, of course.
Right, thank you. Other questions from the board? Okay, Lee, thank you for being here tonight. Appreciate everything you do. We look forward to that new Board of Ed room being all set up.
Yep, us too.
We all do.
Yeah.
Thanks again.
Yeah, thanks again, guys.
All right, take
Take
care.
care.
Okay, so we're going to move on. The next item on the agenda is debt service for the town. This was an item that was supposed to be deferred from one of our earlier agendas because it got late. So this is on page 247 of the budget book. And is this Frank or David? Which one of you is going to take us through this?
Yeah, I continue.
And should we look at what's better, 247 or 248?
248 is the better page. Alrighty, so actually, and I'll just point out a difference that people might see when they look at 247 versus 248. Redemption of bonds, there's three categories of redemption of bonds on page 247, but the first one for 14,802.023 million. If you look on page 248, you'll see I have that number as 15.9 million. And the reason for that is if you go to the bottom of page 248, you'll see you have 1.1 million. That's the reconciliation. So going back to page 248 and just starting from the top, estimated cost to market the bonds and bands. Those are the services of bond counsel and our financial advisors, Phoenix Advisors. Principal due on long-term bonds is the base number that we use, and it's just according to our debt schedule. Use of the bond premium from the debt service fund. It's just an amortization of bond premium that we receive from issuances. We amortize it over 3 years, and that reduces the debt service number every year. Interest due on long-term bonds will be in from the schedule. 600,000 issuances from July 23 that are due January 24. Those are, sorry, that's a typo there, but that's just essentially a half-year interest for new issuances. Bands are per the financial advisors. This is all per the financial advisors. The only estimate I make is a half year's worth of interest, which is just a guess. And this year we did include use of some debt service reserves, which is surplus from prior fiscal years that's currently in the debt service fund, and felt that it would be prudent to use that to offset and stabilize the debt service number. If you look at the total debt expense for FY24 to FY25, it's pretty flat. And I can take any questions as it relates to the town.
All right. Thank you, Frank. Questions from board members on this? Mr. Curley?
Yeah, thank you, Madam Chair, and thank you, Frank. I'm not seeing in this section, and I just need to be pointed in the right direction, but where we see the debt service reserve balances. as it relates to recognizing that we'll utilize 1.1.
Yeah, that's a number that we haven't included in this budget before, but I do have the reserve numbers.
I think we had that at our last.
So I believe so. The FY 23 surplus, this is just speaking to the FY 23 surplus we had. 8,120,000 of that was allocated to Penfield in January. And then this would be 1.1 million of that. So you're looking at about 1.2 million total out of the 8 million of the FY 23 surplus that's used, and the rest would be considered unavailable. I believe the FY 22 surplus is
That was
used up. Yeah.
And is that something that we could get in the budget book next year?
I'd have to talk to Caitlin if she has any ideas why we wouldn't put it in, but if we're gonna continue to use it, then I think it would be a good piece of information.
It'd be best available at that time, but
Yeah, we've never used it this way before. We used it for capital rather than.
we did look in the 58600 use of debt service reserve. Zero use had been.
We did it in the COVID budget, yeah.
Yeah, and possibly even before that a little bit, so it wasn't the object code existed, but to your point, not recent.
Other questions from the board? Right, moving right along. Okay, we're gonna go to debt service for the WPCA. So when we reviewed the WPCA budget, this I believe was an open item. There were open questions. So Frank was gonna do an analysis to reconcile this to the expected debt issuance for us. So if you go to page 8 of the posted backup for this evening. It will be there. So give everybody a minute to go to that, and then Frank will have you take it to it.
Number that was budgeted here was, I believe, so for the redemption of bonds, I had about 678 budgeted, and for interest due on it, I had about $1 million. The redemption and the principal on the bond issuance is staying the same. If you start from the top of the page with the backup and you go down, I listed out the amount that was issued originally and the debt and the principal that's being paid, and then also the interest related to that same issuance. So that's the top two parts. That's the top part there. The interest due on existing debt, same thing, not changing because that's just from an existing schedule. Interest due on bands, very much the same methodology that I use. What's changing is my assumption on the new debt. So originally in the proposed budget, I had $450,000 in interest on new debt. In going through that, I realized I had taken a whole year number instead of a half year number. But additionally, I also looked at the projects that were on the capital plan for the WPCA, and I think that in a Board of Selectmen meeting soon to be announced, or maybe already said, I know they're going to go through these projects and receive the authorizations, but I took the amount that would be expected in cash flow to be bonded for those 4 projects. And I took the half year of interest, and that got me to 282,902. So a decrease, essentially the decrease in this debt service budget for the WPCA would be the 450,000 less the 283,000 thereabouts. And that'll bring the budget down. And I did reflect this on the pages of the backup. There's a page in the backup that it's one of the first pages that talks about the WPCA fund. And I did include the adjustment to interest expense on the expenditure side. That's one of the first rows for the WPCA fund. I'm sorry, I don't know what the backup is. I believe it's page 4 of the backup.
Yeah.
You'll see the WPCA expenditure.
So pages 4 and 5 have the towns, 5 and 6, I guess. 4 and 5. 3, 4, 5.
3, 4, and 5. So three, any backup that you see or anything that was discussed I included as for the general fund is on page 3. Any adjustments for WPCA are on page 4. Any adjustments for FCRD, when we go up with their revenue calculation, are on page 5. And then regional fire school, nothing really discussed for them, and the adjustments are minimal. Those are on page 6. So each page is separate.
Questions, on this item?
Yeah, I'm sorry, I'm just struggling with bouncing between page 8, that's backup, and just focus on 4 of the backup. You help me get to change in the expense that you talked about all year. As I look at page 4.
So as you look at page 4, interest expense, no adjustments from the board of selectmen proposed. So your base number for interest expense is 106 million.
Yep.
If you go to page 8, on the bottom of page 8, the very last row, object 50. Okay.
Yeah, 893, 813.
Yeah.
So I thank you. That connects the dots. Get it. Good, thank you. You're welcome.
Frank,
Mr. Testani?
sorry, Frank, so that was because of that decrease, right, of the 167, 198? Am I reading that right? Not to the.
On which page are you looking at?
So if back on page 4, right, which is earlier was just talking. So the first selectman proposed was 1,060,911. So basically to get to that,
893, 813 is the 167, correct, the 100,000.
and that reflects what number, again, I'm sorry, that's not on page 8, correct? The 167.
It's not, it's, that number isn't exactly on page 8, but you'll see 3/4 of the way down the page. Yeah, if you take the 450 less the 282,902,
At that
you get a
time.
number of 167,098.
Thank you.
Other questions on this item? Okay, no other questions on that. We can move to fund balance. So fund balance, I think you provided us an analysis on page 9 of the tested backup.
Correct.
So there's nothing in the budget book, correct? Because we have not budgeted any contribution to surplus, but you've given us here an analysis of fund balance as it stands. So that's again, page 9 of the posted backup. Is this you again, Frank?
Yes, yeah. So this is really just to say, there's no fund balance budgeted, so currently you're at 11.76%. If you contributed the 1,225 that was budgeted, you'd be at a percentage closer to 11.85%. So at the end of the year, for the do no harm policy, if you're going to stick to that, you'd have to transfer some amount for the end of fiscal year 24. Not exactly the 1,225, but with the expected surplus, I think there'd be plenty to set aside, at least for FY 24. And then if we wanted to set aside for FY 25, we could, or if you wanted to wait to see how the fiscal year is going for fiscal year 2025, you could do that as well. So this is really just to say, don't see any expected issues with staying within the policy and funding the 11.76% fund balance. This is really just a, talking point. Say.
Great. Questions on fund balance?
Can I ask a more general question?
Yes.
I know that this board has always tried to follow the no harm policy. It's a good one, which means that percentage reflected in the fourth column here should either stay the same or grow, right? That's like, we can all debate or discuss whether we want it to grow, but I think probably all on the same page that we don't want, Frank. So I guess my question is, last year we did budget $1.25 million to maintain the percentage at 11.76. Reading this correctly, don't adjust that dollar amount down. We're going to actually increase for fiscal year 23. And is that something that we do want to do?
No, we didn't budget that 1.2 there. So I think that's what Frank's saying. So there's 0 in the budget. So if we don't put anything in from surplus, the percentage will go down. But I think Frank's saying,
Well, that's for, so the last row here is for the current fiscal year.
oh, I'm sorry, for the current fiscal. And wait a minute. Why would that go up then?
It's just because originally in the original proposed budget, you had the 1,225 million.
That was budgeted, yeah.
That was budgeted.
Sorry, I was thinking of 25.
So that's saying if you continued, there may have been transfers made from that, but if you stuck with that idea, you'd be over.
Well, so, and just so everyone knows though, so we had the meeting that we had to approve the department transfers for the severance and all of that. The offset to that was gonna be this budgeted surplus.
Right.
So assuming that goes through at some point, for whatever goes through, we won't actually have the 1,225, so we'll be a notch below that. Either that, or we can decide before the end of the fiscal year, if we want to keep it at exactly 11.76, we could take the excess out and put it into debt service, which is kind of what we did last year.
Right, and then if we don't have to make that decision until closer to the end of the fiscal year or even after, right? And, but if we're operating under the assumption that that's the path that this board will take, then we can take that into consideration as we consider what we want to do for the fiscal year 25 budget, right?
Yeah, so for the fiscal 25 budget, we're assuming that whatever we put in here to hold harmless will come from surplus.
Yeah. Good, thank you.
Any other questions on this? All right. Okay, so we can move on then to investment income. So this again was a follow-up question. We briefly talked at the end of the last meeting about the change in the investment strategy that was going to be and cash management that was going to be implemented to reduce the risk profile that we currently have. And there was a minor, that might have a minor change in rates. So you have prepared something on page 10 of the backup.
Yeah.
So does this address do you have anything else or do you want to?
So there's 2 pages related to this item, page 10 and 11. Page 10 addresses a question of my assumption for interest on our cash, so to speak, and that's what was in this. I created an assumption at 3.94%, and there was a question, well, how did you get to that? So I just looked at some quarterly interest rates that were provided when Janney did their investment income assumption. And I just showed the sampling of 3 rates that I used, and I just took the average of those. That's what's in the box, and that's how I got to the 3.94% for the investment income in our cash, which assumes, as you can see from what's in the box, there's certain rate cuts and assumed. This was before, there's always conversation and who knows what interest rates will be. But I would imagine if you did this today, the numbers would be a little bit higher, but this was at a point in time that we did it. So that explains the 3.94%, and I could stop there. I could go on to the next page.
Does anybody have, Rotolo, questions on the
So-
394?
If I remember our discussion the other night on this assumed these numbers, there was assumption that there would be like 4 or 5 interest rate cuts for the upcoming year. Is that correct?
I think it was around 4 or 5, yeah.
That's fine.
So now we're thinking maybe 2 to 3, at least that's what the Fed's saying. So,
That may be, that may be closer to actually.
and you just said it a minute ago, I'm not saying we would do this, or maybe we could consider it. This number maybe would be a little higher.
I mean, yeah, theoretically it could be, but who?
I know.
Yeah, that's.
I'm just throwing it out there, but for everyone to consider and discuss it, but
Yeah, if you look at the median daily balance, there's a couple different factors that are in here that are all add a piece of conservatism.
Sure.
Same with the rates. This protects 5 interest rate cuts between, and that also assumes, like, as an example, if they happen halfway through the fiscal, you've already earned at the higher. So this is going to be phased as well. Assumed some, because if you look at daily balances at 93, we took 40 off of it, assuming that we were going to try to accelerate getting some of these projects moving. Same rate, we go out to the markets in July, and that goes right into, it's going to be another roughly 40 million that goes into the coffers to then be spent down. So you're going to earn probably at a higher rate and on a larger amount through probably about half the fiscal. So this adds. So what we tried to do is we tried to say, okay, it had already been budgeted lower. We wanted to try to chew this up some, but we were also trying not to be really aggressive about it. We wanted to sort of a pathway, because you never know.
I know it's different. What did we budget this last year? Do you remember the rate we used? Was it 3%?
We use 3.5.
8.5, yeah.
Yeah. Half.
And lower balances, so it came out to, I mean, that's your 5.1.
Yeah, well, I thought we tried to use the average balances, but one of the things we did was we had a big cushion in there for that Janny mark-to-market number, which we're not doing.
We're not doing that either.
So our budget's higher. This budget is higher than last year, but this budget is lower than the actual run rate from last year
Right.
in anticipation of rate cuts.
So we'll have to mark it against the budget as it rolls into our overall financial report. At the same rate, it's going to work the other way around as the value goes up and the rates go down. So we'll see the same thing on that. We hold them to maturity and maintenance and stuff.
Just throwing it out there. Thank you.
Great. So the second part of the question was, we are moving these funds and taking them out of the STIF, taking them out of or at least some of the excess cash out of our money market account and investing them in treasuries in Schwab and Fidelity. And I didn't see it on the backup you provided, but were you going to give us some analysis on the differential, just to make sure that we change the estimates materially?
So, perspective on the funds that have been moved at this time, that nets out. One of the blocks of funds. And the STIF and the M&T funds were at roughly 5.2. So
Same for now.
and we don't intend to see anything, shift from a rate perspective. If we do any adjustments, in funds which were not in money market type accounts, then it would be in the same sort of laddered approach, same general rate structure. I think the biggest piece would be that we would move more to treasuries, where some of this was CDs, some of this was treasuries, but there's definitely some other fits within the investment policy guide, but not solely in those buckets. And the only thing that we've discussed doing from an interest rate protection standpoint is maybe going a little bit longer in that 5-year, more of them in the 5-year bucket to capture the rates. Knowing that when you talk about fund balance, some of those places we're not going there anyways, so they don't need to be rolling on some of those 5-year schedule, and save the town sits on enough liquidity out at roughly 100 million plus.
And
outside.
Janny was doing that anyway, right? Janny had us in the 5.
And some of this, if we shift some of it away from Janny to the Schwab or Fidelity approach, they're not charging a 15 basis point spread, which net down structures 243,000. So you capture a piece of that by doing that. The ones we're in right now are in either no or charter-based funds too. So it's our exposure.
Mr. Testani?
Is there a list? I think we kind of talked about it where the funds are now is there just 2 funds? Did I understand that right?
You mean the 2 new accounts?
Yes.
Maybe other than.
Right. So we took a substantial amount of money, right? Correct. And we put it into Jenny. I got a little, so I'm sorry, and I know you probably.
No. We can prepare, a schedule. It's only currently in, there's a very, very small amount that sits in stiff and that we have to keep it on balance.
How much is that?
Open. I can get you that tomorrow. We took 35 million out, so.
Out of,
It's stiff, which was the bulk of the funds. And
that you put into Fidelity?
and that went into Fidelity. And then that sits in a treasury fund, which are,
At the 5.18?
Fidelity would have been 5.23.
Well, you said 5.18 or 5.23?
5.23 would be Fidelity, 5.18 Schwab, and I can confirm that tomorrow.
When you say Schwab, you're talking about a similar account? I'm guessing we're not.
Correct.
Into either treasuries.
Yeah, you could have, we could use one. I think our approach was just not to put, even though they're sort of deemed, they don't have commercial or really any loan operations. They don't do any internal trading desks. So they're considered similar to like a Vanguard, very safe locations to have custodial accounts. But from a diversification standpoint, one of the thoughts was just not put everything into one institution. So the idea was generally to keep them around even. So Schwab was opened first. We were trying to move money out of M&T, so we moved a $50 million block to Schwab.
I'm sorry,
50 million.
50 million to Schwab, okay.
And then we had the stiff funds, which was 35, so we moved that into Fidelity. And just because where we are in the collection cycle right now, there will have to be some drawdown of funds.
Yeah.
And then you'll see the collections will cause it to surge and then have to send them back up. So, which the wires go nowadays, wire desks process so fast at these institutions that we're talking about 20 minutes at the time you're seeing them show up. So, we're able to move the funds and get it right back out to the tissue shack. So,
So the total was 85 million?
85 million, correct. Janney has 100 and shy of 130 right now. M&T has the rest. M&T sitting on roughly 15 to 20 million range. That changes almost daily.
Thank you, Mr. Testani. Ms.
My question was, how much is that in M&T? You just answered it.
Yeah. I mean, last week as an example, about 10 million went out, but it was just a timing thing between the towns. So if you ask for one day and again, we're in the collection cycle, so it's going this way.
And that's the one you said you're going to try to manage lower as we start putting in a process in place to forecast our cash.
Correct. And we're trying to manage it down to a point where we can at least put into what they call their, while we're at M&T with even the lower amounts put into the certified account versus our sweep possibly. And it might cost us a point and a half. So we're trying to manage that number down, but then we have 1,000 bank partner network.
So be all FDIC insured at that point.
Yeah, and you wouldn't want to necessarily have left it all there and done that because then you would have seen them, you pay it in the rate. I mean, they put it as part of the inter-5, but you pay it in the rate. And it's not cleanly in your sweep account anyways. It has some more transactional pieces.
Mr. Curley?
Thank you for that. That was helpful. Mr. Becker, question, is the longer term, I understand there needs to be a transition period in managing the M&T account, but is the longer term or is it to just minimize the exposure?
Right now, we're evaluating that and minimizing the exposure is priority. Getting a better handle on cash flow. The finance department currently do not run cash flow. They time it out. Some departments, municipal would do it daily. Some do it weekly. We'd like to get to a point where it's done daily, and then we can have a much better handle on it. So we're trying to work on that now so we can continue to manage it down. So the risk point of managing it too far down and not knowing necessarily how much you have outstanding.
I didn't know what the longer term expectation was, so that's fine. And then you mentioned that you were on the stiff account, you were not taking that to zero, you were maintaining some level to keep that account open. Is that also the plan to keep that account open? So we'd ultimately have 4 accounts?
Correct. The STIF account, there's a few things on this, on the STIF, and we are trying to work through this too with example, same with the Board of Education. There's like, they have a school lunch account, not on the STIF, but on the M&T side that's segregated. And the Parking Authority has an M&T account that's, and then also has a STIF account that's segregated. So, but they're all riding off of our EIN. So they're all capped at, your normal exposure, 250,000 overall. So we're trying to kind of work details. And our STIF does have we left a small amount because some of the money that the state pays, they typically, well, we can point them somewhere else. They seem to like to send it to the STIF account, and that's currently the one that's set up. So we didn't want to bleed it down to zero and cause a closure. We wanted activity and leave it in place, but let it most of the way down to get it out of there, because it really does not, from what we have pieced together with it, it does not meet our guidelines. While it might meet the state, it doesn't meet ours. So you'd want as minimal as possible to sort of just check the box.
So fast forward a year from now, you'll have better controls in place, better reconciliations of the activity, but we'll still have 4 accounts. That's the expectation.
I would say 3 to 4 institutions. I mean, obviously, at some point, if you change, it's called up to 4.
Yep.
And then I would say, fast forward 12 months from now, yes, but that timeline will occur much sooner than the 4-month window. Our goal from a cash flow perspective would be fast forward, roughly a month from now, if not sooner. And as you can see, on the issue as far as the accounts and where the.
So 4 in addition to Janney.
Before, in addition to Janney, and we're evaluating.
Fidelity, Schwab, M&T.
Yeah.
And Janney.
Yeah. Thank you.
Mr. Penley.
Is there any, I just don't, not familiar with, is there any advantage to the STIF account? Like why do municipalities bank there, so to speak, or custody there? What advantage does it give?
So, from what I can tell, they like to send the funds there from the state. That was one to have it open. Trying to evaluate if we simply can just tell them to go somewhere else, because I think we might be able to do. Right, we can still transfer. The pitch with that was it was a good rate, and when you go to the website, it's got the state of Connecticut seal, and they boast of hundreds of municipal, quasi, et cetera.
It is AAA rated. It just
doesn't meet our guidelines.
That's for many municipalities, which is the intent of the program, right? To support the municipalities.
Yes.
It's just we have a strict.
Yeah. It's not a knock.
You're handling the actual investment of the cash that sits there. Is that?
the treasurer, the state treasurer runs.
But it's gonna essentially slide at the same as putting it, in money market, right? If you look at the history of the rate on it, right, they publish all their monthly rates for years back. It generally moves in a similar
So
fashion.
it sounds like the main reason is because it's easier for the state to deposit money that they give us there.
And I think if you don't want to, if you're a municipality, you don't want to put it all into, say, regional or national, whatever type of bank, and you don't want to go and brokerage or anything like that. I mean, it's a logical place for a lot of municipalities, and for years it's served us well, but it doesn't necessarily meet our guidelines, and we believe that we want to be Treasury, which was about the safest place, more safe for custody. That's no knock on any of it, including the regionals. It's
Just what the policy says.
I can say that the state of New York has something very similar where it's an option for municipalities that may not have as much of a sophisticated, some municipalities may not have an investment policy if they're smaller. So it's just an additional option for them to get yield outside of what they may get at their regional bank, which are typically just lower than the Fed overnight.
You just asked something on the stiff, and I know Jim's hands up.
Yeah.
Is this on this, Jim? I want to ask a question about the stiff.
You go, no, John, go right.
Just explain to me why it doesn't meet our guidelines from the stiff.
Has repos in it.
Commercial paper too, right?
Commercial paper. If you look at this, if you look at the website, you'll see, and it, you know, shame on it. I always thought that the stiff had short-term treasuries underlying it. But if you actually go look at the website, it's commercial paper, it's bank, you know, bank deposits, it's stuff that on a standalone basis, our investment policy would not permit.
Thank you.
Mr.
Thanks,
Wall.
No,
Jim.
that was gonna be one of my questions, so I forget. Thank you. So if it doesn't meet our investment policy, that's correct. You guys want to get the money out right away. Why don't we get all the money in? If you think you can get the state to fund move them in another account, we have, why can't it be done like within the next 6 and 12 months?
You can buy all the money.
You said there's some remaining balances, and I understand there's other accounts. And I understand that you have those other accounts that you need to clear out. You'll start establishing accounts for those someplace else, correct? Because they don't meet our investments. So they should all be out. It should get down to zero.
I mean.
I don't see any reason why it shouldn't.
Yeah.
I don't know if you heard
That's
what
one
he
of-
said about the other, like the school lunch fund, the other
Yeah.
attached accounts,
When will that be done?
The stiff has $500,000 from the parking authority. We're going back and forth medicine wise, but I wanted to, that block of funds, I had wanted to sit down with them and actually discuss the movement of the funds from them, right? So that should be within a few weeks. That was mostly just a timing issue on their end and when they're can be there because they want their chair to be there. We're going to discuss the leases, the budget, in-kind services and the health and all other funds, kind of all in one shot. And I can get you the number tomorrow for the amount of money that's remaining in the main town one, but it is, it's a small number. The bulk of it's been booked.
So within 6 months or less, it'll be down to zero.
If we can confirm the state will not close the account or will transfer somewhere else. And if any funds are left, I would say it's gonna be one of those, leave $100 in the account or whatever exact minimum number in order to appease the state on the fact that that's where they transfer it. And I would say that's in kind of our 30-day window.
In the 30-day window, you think that'll all be taken care of?
May I interject? Why are you asking this question?
I just want to know, because if it doesn't meet our policy, we might need to get it all
I think
out.
part of the problem
It shouldn't even be there.
So
Yeah, no, and I think part of the problem is that we receive money in that account from the state, am I right?
yeah, so I did
So
wipe it out. I was told
we can't answer that until we know.
So, Mr. Walsh, I had asked the controller how much was in the SIP account. I was told roughly 35 million. I said, please clear out the $35 million. And then let's sort out for that very small amount beyond that. Let's sort out whether or not the state of Connecticut, if we can just simply close the account or what the minimum to keep it open. And the goal was to get the top line number out and then quickly the rest of it. So I would anticipate in the next 30 days, it's either gonna be shifted so the state sends money somewhere else. Or do exactly what they, like a typical bank, keep X dollars in it, remain open. It tells us we have to have it. Because our goal is to no longer utilize the stiff.
So if it comes back that the state will only fund a stiff account, then like every day you'll look to see any money came in and move it out?
That's what we have to do, but I would have to, I'll make an assumption here that we know, we get some sort of a notification when the state's gonna send money into the account. It isn't like they're sending money every day for things and set up whatever triggers to do that. So there is a goal to move to a point regardless in all of our accounts where we're reconciling this on a daily basis. So if we get to that point, then sure, even if it's a manual process.
On the Janney,
Yeah.
okay, thank you for that. I appreciate that. On the Janney income, Janney accounts, there seems to be two. Are we gonna be, the plan is to stay with Janney? Is that the plan? For this coming budget season? The budget year that we're talking about right now?
We are considering moving from Janney, in which case we would do an in-kind transfer with the Janney allocations.
Okay, and what's the plan to move from Janney? And when?
I'm sorry, point of order, Madam Chair.
Yes.
Is this an investment committee meeting or is this a budget meeting?
Yeah, no, that's a good point. So, okay.
Well, it's a budget meeting, right? So I could talk about the income that's there, right? So I want to know when it's gonna be moved
Okay.
and what the interest rates
I
are.
think let me just, so if we're gonna move the bonds over in kind, then the bonds are gonna move from this to a different custodian, so no change in the investments. Is that what I heard?
No change in the assumption.
Yeah, no change. We don't anticipate a change in the assumption if anything would go in the other direction, dropping it.
The bonds are gonna move is the thought to hold on to those bonds during the current coming year, starting January 1st.
We would hold on to the existing portfolio, and then as they are rolled off, we would then begin buying them into treasuries. Correct.
So
Some
as
of
they sell, I just want to understand it. So as they mature, would you take the money and you're now going to buy treasuries? Will the interest rates be lower than what? Because I heard, I only knew his first name, Guy, talk about that there was going to be some longer term held bonds in order to manage the interest rate, the longer term, so that part of the portfolio was more in like treasuries and the other parts were in longer held bonds, so that we could blend that and get a better interest rate in the next coming years as interest rates are declining as expected, at least forecasted right now.
As I mentioned earlier, one of the things that we're looking to do is to buy more 5-year window bonds,
Treasuries, right?
treasuries, in order to capture the higher interest rates and reduce the exposure as interest rates decline.
Okay. And you believe that those treasuries will be getting us the same rates? And Guy's prediction on what they're buying?
Near term, yes, and you would be feeling the same pressures as we would on the backside of that as interest rates decline.
Okay. So as we're sitting here today, you believe that in what you're planning on doing and possibly leaving Janney, you'll be able to match the numbers that are on the sheet on page 11 on the top line and also on the third line?
Yes.
And just one last clarification on that point. So the motivation to move away from Janney is just to avoid the fees?
Sorry. There's two pieces of it. You know, Janney may have said something about liquidity. Actually, their portfolio is not very liquid. And so if there was a crisis and the market went crazy, we would take a bath if we needed to liquidate it. And so.
Is that because of the lack of trading activity on those bonds?
They buy odd lot securities. It's not a very liquid. So plus the 15 basis points. So right now there's really no benefit, but we should actually match or do better without the fees and be more liquid.
But we're gonna hold them until maturity, and when they mature and roll off, then we reinvest. We're not gonna sell any now because we can take them.
Do well liquid.
Yes.
That to me makes sense.
Thank you. Other questions on this budget item? Mr. Walsh?
We're going to talk about possibly going to a higher number based on what paying $243,000 fee. That, which is if he was going to price this as of today, he would go with the slow rate cut scenarios, which is a higher income. Because I'm kind of leaning towards that. I just didn't know whether we were gonna have a conversation about it.
Have a conversation about it. I guess, I mean, it's a good thing to hear everyone's thoughts on. I've thought about it myself. I guess the couple things to think about. One is, we potentially will have a higher cliff in the future, obviously. If rates do decline, a budget cliff. Secondly, I guess, which is what it is, things go up and down. I think the question is, in my mind was, I think last year, this board we had a split vote on even increasing interest income because everyone was concerned and wanted to be conservative, and we didn't feel like we wanted to be in the business of, predicting whether interest rates were going to go up or go down. And so there was a desire on the board's part to be conservative, and not to budget for too high for investment income. So we ended up increasing by a couple $1 million our budget, but we still kept it pretty conservative, and I think had some internal disagreement on that. So we can certainly have a discussion about it and kind of see how people feel about it. And if there's a desire to vote on that, we'll vote on it when we vote on the budget. So anyone want to weigh in? Mr. Curley?
Yeah, I was hoping that we could, I agree with you. I heard the same thing, in terms of the budget was based on a more projected cuts, and now it's in the news that that's highly unlikely at this point. So I do think we should take that into consideration, but I was actually kind of struggling with it. I understand on the back of page 11, the second line item is a non-event for us because we're including the mark-to-market in going forward. But as I look at the first and third lines, those two numbers are moving inversely. And I would have thought that they would have moved in correlation, but I'm not following the math there.
What are you looking?
So I'm looking in the base scenario, the top line is a 5,027,000. If you assume a faster rate cut, which we're not going to do, that number would come down. And if you expect a slower rate cut, which we are considering, that number would go up by roughly 200,000. If I look at the third line, which is the Janney investment income, the base scenario is 3.9 million. In a faster rate cut scenario, that number doesn't go down, it goes up. And in the slower rate scenario, it doesn't go up, it goes down.
Right, because of the mark-to-market.
Because of the mark-to-market.
Yeah, because the theory being that, if we're.
So we're only looking at the top line.
Yeah, so we're not doing the mark-to-market. So if rates were to be cut slower,
Yeah.
then that means rates are higher, so our existing portfolio would be worth less, so we would have a higher mark-to-market.
So we have a potential.
But we're not budgeting.
Upside to consider on the top line. Got it. Thank you.
Yeah, I guess the thing is though, so that's a $200,000 difference. How, and Guy said, how much of the portfolio does he expect to roll off in a year? 20%. So the Janney fees, we're still gonna be paying them fees as long as we have our money with them, right?
As long as they're there when they go to do the reinvestment piece, that's where you're paying it.
So we're not paying based on the amount of our portfolio? Like, what's the fee based on?
My understanding it's on the purchase. It's a spread.
I actually think it's on the amount. I mean, I'd have to go back and look at it, but I think it's on the amount of money. I think it's on the amount of money that we
The
have.
size of the portfolio?
Size of the portfolio. It's 15 basis points on this.
So that fee that we save, so the fees that we show as 243,000, and they've given us that.
Well, that's not all, Janney. I think
That's the whole, okay.
that's M&T charges some bank fees.
So what do we pay Janney?
In there. So whatever the 15 basis points on 120 million, give or take, so.
Again, and you know where I'm going. My question is, even if we just.
So then 180,000.
108, so if we decided to let the Janney portfolio bleed off, and maybe we wouldn't for some reason, because maybe things happen differently with treasuries and this, maybe we decide to hang on to some of this stuff, right? Who knows? But the question would be, would that, if we made the decision to let the Janney bleed off, instead of reinvesting, would the whole 180 go away, or would we still be paying substantial, 80% of that based on how much is in they're managing for us?
With my understanding of the fee arrangement is that it would proportionally, decrease because it's based on.
So we'd only save like $35,000 or something this year,
Yeah,
like 180 times, all right, whatever. Okay.
But if you transfer in kind and then all the money, I don't know how that would.
Oh, okay. So if we transfer in kind, then we're not managing, okay.
Exactly.
So the whole thing could go away. And Fidelity and Schwab don't charge us anything,
All right.
no fees on that. Okay.
So the idea was to roughly cut it in half and split one block to one institution and one to another.
But have we made that decision though? We have, or not? I mean, I wouldn't want the board to vote on, for example, just theoretically, eliminating fees. If we're thinking about moving this portfolio.
I would say we're at that. Now, we're like at the 5-yard line and we're about to carry it through.
Okay.
Has it happened between now and your vote? We're in that 30-day window.
It's highly likely.
It's highly likely, and I do agree that, I do think that if there was a place that made the board go, might be utilizing some of that fee savings and deploying that out into some of the things like what we did earlier. There's some personnel pieces there that be much higher impact to the municipality.
Did you have a question? Yeah.
How long has Janney been with us?
2 years?
Roughly, yeah.
2 years? And the money that we're moving around, do we have an investment committee as to First Selectmen's, when he said this is an investment committee, do we have those
This
meetings?
board does not know.
It just seems like there's a lot of money moving around between different banks and I'm just, I was just, because it does impact the budget to the extent if fees change or the structure changes or the risk or the model.
And do you remember when
It
we?
seems like there's a lot of money moving.
The investment policy?
There's the
Was that
one,
like post Madoff? Like, when did we do that?
I think it was updated recently because, or at least it was looked at recently because I was looking at it, I was actually looking at it today and the signatures have, I think they had Jared's, Brenda's signature.
Yeah, but I don't think just I've been reading the CAFR for 5 or 6 years and it hasn't changed. So they might have just re-upped it.
That was.
Do you remember?
I don't think I wasn't on the board when that,
It's very after made up.
it's 2008, right?
You chaired it, Jim, right? Did you chair it or you were on it? I remember you spearheading it I think when I was on the board or right before.
Take a look at it.
It's been a while.
Sorts of things.
I was just gonna say, I think you're hitting on something. Whether we move, it has nothing to do with moving money. The lack of an investment oversight led us to have $120 million and I agree with you that we need more oversight. But I would consider different structures, but really for the future of the town, it's a lot of money, and we've got great people on the pension board, post Madoff, that they sort of made a transition to highly qualified people. And it's not as complicated as that, obviously, but probably should have more transparency into money, that amount of money. And so I would even ask if it's possible for the pension, board to maybe once a quarter or every 6 months, just take a look at it and ensure that it meets some of our policies. But however, whatever policy we put in place, if it didn't include contingencies, then it wasn't complete. Then we can include that in the next.
to the extent it's not, I mean, if we're saying we're making the same assumptions and we're moving from one bank to another, you know, from the budget perspective, I agree there's, you know, unless something changes, we're not making a change for the budget, but maybe it makes sense at a different point in time to have a conversation and just look at the, you know, the different, because to have that much in one bank, I don't disagree that just sounds. And the one fund that you have the fees and the, you can't liquidate it quickly in case of an emergency. So maybe it makes sense to have a separate look, and I don't know if it's us combined with the pension board or it's them, but somebody looking at it.
I mean, that group is really qualified to do it now. I don't know if it will always be, but now they would be qualified.
Well, Kevin's our bond guy, right?
Yeah.
Yeah, I mean.
When bonds come up, I'm looking at you.
MF Global went bankrupt. I think accounts like this one were not segregated.
So
Your recollection?
I had money with it. Well, I know this very well.
Yeah, so
So
we do need to diversify it, I think.
Yeah, no, I don't.
theoretically, yeah, John Corzine somehow managed to make bets in the European bond market
Yeah.
with segregated account. But they are, you know, that's brokerage. Schwab, these are, that's why we're not going with the
Yeah.
that makes bets on their own book.
Yeah.
Maybe we just take it offline, because Mr. Walsh's point with asking the questions and your comment back, I understand, I mean, should probably discuss it at some point further.
Yeah, agreed.
Can't we just move treasuries from one account to another?
Sure.
So we don't need to sell anything. Just move.
No, that's what we were saying. We're gonna in kind it. That's all.
No, Jenny does, we don't have treasuries though. We have like what municipal bonds with them?
We've got,
Those can be
We do have some treasuries.
Oh, yeah, that's what's.
Some fees, I mean.
for minimal fee. I would.
I mean, the thing, it's like I think the duration is like 2.5 years. So, you know, if we had to bleed it off there, we could, you know, do that. But if we can move it in time, which we think we can, even if we don't liquidate, it's still all gone. Sure.
I mean, I'm gonna give some unsolicited advice. If you're, I mean, right now, if you're confident that rates are gonna go down, do you wanna buy as long dated treasuries as you desire? As long as you're sure you don't need that liquidity, because, you know, a bond that's yielding.
Policy says that it can't be, I think, more than the maturities can't be more than 5.5 years.
Yeah,
Okay, so, yeah.
And I think we're not confident, because one of the things, honestly, my question is, why the hell do we have $200 million of cash sitting around, you know? Honestly, it's kind of crazy when you think about it. We have a fund balance of $40 million in the general fund, and yet we've got all this cash. We bond, we're like, you know, and that I think gets into what the first select talked about with, you know, our capital planning process, when we're bonding, how confident we are about when we're going to spend the money, are we bonding and leaving money sitting around and all that stuff. So I think if we don't get a cash forecasting process in place, I don't think we're going to have the confidence to be able to go toward long dated treasuries or anything else. I mean, we've done it with half our portfolio, but you know, that 20% of that bleeds off every year. But yeah, I think there's a few pieces of this, and it's just, you know, we have an astonishing amount of cash. Some of it's going to go away. We're going to spend off the ARPA money. We're going to, you know, hopefully get better about our bonding and our capital planning, and that will help. But yeah, that's going to be the issue.
Sitting on bonds, bond money on and on now without expending it on the projects they were intended on, that we're paying a consultant to arbitrage calculations based on the investment.
Yes.
So we've got to, I will bring that down. It won't necessarily rise to that $250,000.
All right, good discussion. All right, so anything else on this? All right, so we can move on. The next item on the agenda is contingency. Okay, so all right, so let me just say a couple words on this. All right, so first of all, we're on page 95 of the budget book. So this budget item, contingency, most of the board knows this, but just for the public. So this budget item historically has been used to capture estimates for retro pay on collective bargaining agreements. So until those agreements are settled, the amounts, any, estimates to make retro pay are included in the budget in this contingency amounts. And so while the contracts are open and under negotiation, any discussion that this board has on that topic, we typically do that in executive session. And tonight we'll vote on going into executive session later on item 4. However, the reason that it's in item 3 here as well, a few years ago, the former select women started a practice of also budgeting discretionary department head raises in the contingency budget rather than putting them in the department budgets. And First Selectman Gerber continued that practice in this budget. And based on guidance from our current town attorney, budgeted department head raises that are in contingency cannot be considered confidential under they should not be discussed in executive session. So for that reason, we have contingency on this agenda twice. So in item 3, we'll talk about a portion of that contingency budget that relates to department head increases. And then in item 4, to the extent this board votes to go into executive session, we will discuss the other piece that relates to the open collective bargaining agreements. So for the first portion, which is department head raises, Frank, did you prepare something additional for us, or is it all in the backup?
I have something additional. I can give it out. So what's in the backup is somebody had asked, can you split out?
And that's separate, so let's do that separately.
Yeah. There was another question regarding department head, and I included it with the contingency stuff, so I just have to separate it, but I did break out. If you assumed a 2 3/4% COLA for department heads, that would be essentially on top of the numbers that you have in the department budget. That's what they're making currently. So I have that. I could pass it out. I just have to separate them out from the back.
Okay.
So. FairTV has access to elevator music. That means it's time to play it.
Yeah.
We gotta go that way to pass it.
Go that way now.
I'm gonna get up.
All right, I still need one here and then.
Does we need to share? You're gonna keep that.
All right, so we should probably, we should put this in the public record at some time, so we'll do that. We can attach it as posted backup for whatever our next meeting is. Okay.
So this is essentially, if you take all the department heads and you take what their current salary is, which is the salary as it is in each personnel summary of the budget book. The number for FY25 is their current salary. As Lori said, practice up to this point for a few years has been budget the increases and contingency for department heads, and then they get added, and then you're truing up in each budget book year, you're kind of truing up to their current salaries. So this would kind of be, a correction to that practice or a new practice moving forward where you would take salaries in the budget book and you would add an additional, you'd add a cost of living adjustment, and the amounts are listed here. So I'm just taking 2 3/4% multiplied by the salary in the budget book, and to get to the amounts that would need to be added to each position to get you to a estimated payment for those positions in the next fiscal year. The only ones that are blanked out are the elected positions that, the board set the salary. So I believe last budget cycle, you set the salary to the town clerk, which was for a number of years. So I already reflect that in the budget. There's no need to allocate a contingency amount. There's no need to do that. Same thing with the first selectman. It's set by the Board of Selectmen. There's no need to anything additional, and because that's per separate schedule. So,
So right now, 105,088 is the amount in contingency for department head increases.
So I sent this, and this is the part, because it's on the contingency sheet, but in preparing the backup for this meeting, I noticed that I transposed the cell with the nurses and the department heads, and that led to, there's about a 90,000 is about what would actually need to be added to the budget for this, because the contingency was short, and I could go over that in the contingency calculation. That was
So there should be 105,000, but there's only 15,000 in contingency right now.
yes.
So we need to, so in order to, if we were to true this up, that would have to be one of the budget correction items to add 90,000.
Yes, correct.
Either to contingency, or we clean it up and transfer the right amounts out to the departments
Correct.
to get
But either way, bottom line, is it an even
90,000.
It's, what is
You'll give us the exact amount on an updated
it?
budget.
Pretty much an even 90.
Okay. All right, so that gets deducted from Frank's salary. Okay,
Are there 4 police captains? Is that right?
Yes.
Mr. Terrio.
So I just want to ask you, for example, the CFO that we haven't even hired, okay, is $190,000. And on top of that, we're gonna give them an adjustment. They haven't even been hired.
I could remove it. I just,
So it's 85,000.
So let's take that out. But then, but what other of these, are there any other of these lines in here, like the CFO, that are in the process of being open jobs that would not be subject to like these increases?
it came up in the talk about longevity, and maybe it'll come at that point, but it would be the placeholder, kind of chief admin officer, but I think that coincides with another.
Yeah, we have a
Item on the
separate
agenda.
item on that. That was a separate follow-up item, so yeah.
That's the only one that I see here that's the only other one that I see here. Everything else.
So the chief admin officer, the open question that was on the sheet for that one was, did they also benchmark that to market similar to the chief fiscal officer, so that we could understand we had a reasonable amount in budget? But agreed that they shouldn't, I guess let me ask a question though. Let's say a chief fiscal officer gets hired May 1st. Would they, I assume they wouldn't, would they not get a raise this year? I assume they wouldn't, but is that okay?
I've never thought about it.
Okay, but probably not, right?
I've never seen that done. They just got hired.
Who knows around
Unless it's
here?
contractual, I'd say a hot no.
I would hope not, but who knows? Okay. There might be some policy floating around that none of us have never seen before.
We were going back to longevity bonuses because they were in all of the budgets, and I thought that was gonna be a separate thing.
Yeah, that's a separate discussion item, because there's an open issue on that. So this is just the contingency. So if we need, let's say we need 100,000 in contingency for department heads, right? It's the 105 minus the CFO piece. So we need 100,000. We currently have less than that. So we either need to get to this amount in the contingency line item, or we could also make an adjustment when we vote to take this, given that it shouldn't be confidential and it should be in the departments anyway, we could make an adjustment when we vote to put this stuff back in the departments going forward. I don't care this year, but either way, we just want to make sure we have the right number. Mr. Walsh?
How do we get to the 2.75% increase?
Generally, the department had increased, this is just a cost of living adjustment, and generally it's been, you know, that's been the general cost of living adjustment that we budgeted. So that's
That's based on national numbers, cost of living numbers, or how does that?
it's just based on,
It's based on what the union said.
yeah, you know, contract, you know, what contracts have, for the contracts that are existing and have been settled that carry into fiscal year 25. Like, for example, the police department, they have a 2.75%. So generally we've kind of kept in line or somewhere around those.
What's PETA's this coming year?
PETA's is expired. So PETA's expired at the end of fiscal year 2023.
But doesn't department heads follow a lot of the PETA contracts, the benefits and everything else?
Traditionally they have, but I think that's kind of something where I think we're at the point where is that the best practice to move forward? I would say they don't, because there's a separate policy that's being evaluated for department heads that is a little bit different from the PETA contract. So if you're following that exactly, I would say that they don't necessarily follow the PETA contract.
And then the chief administrative officers listed here, we had a conversation during the first selectman's office budget about how many department heads are in the first selectman's office. And Bill, you said you were going to look at that, because really there should be a department head. You're the department head. You're selectman's office. You're the full first selectman. I don't understand why people in the first selectman's office, no matter who's first selectman or first selectwoman, why are these department heads all over the place? You know, there's just multiple department heads, and I don't think it should be the case. They're political positions. They change on elections, and you said you were going to think about that. Just don't know whether you've given any thought to it, because
Think about whether I want a chief operating officer.
They should be designated.
But it says department heads next to their names. That means how many department, that's not in your book. In your department, I think, you're a department head. I think there's two other department heads in the first selectman. Why that is.
Per that policy with the severance and all that.
Yeah, no, but every, you know, I didn't really notice it until this.
Oh, yeah, in terms of what's written next in the.
Yeah. You were gonna look at that, and that was a good point.
It is a good.
Yeah, I think
I really don't.
that's part of the open question, right? So we had asked the town attorney to look at part of the issue, right? We became aware of this policy that covered severance and all these other things, patient sick, longevity increases for quote unquote department. And part of the question was, why is the chief of staff a department head? You know, why is so there were people who historically have had titles, but they were attached in the system as department heads, and they got the benefits as department heads under these policies, when technically they might not have had anybody reporting to them. So I think part of the question was, are they department heads under the policy? Like, how do we designate that? So I think that was the open item, but we don't have an answer for that yet.
I don't have an answer yet, but because so much is going on, but I don't even know what it means for them to be department. What are the benefits of?
Yeah, I think if there's a designation in the system where that entitles them to certain benefits, that was one of our open
Right.
questions.
If they're listed in here, whatever policy that is, change it right away, or when you don't change it right away, they still qualify that because they're a department head. They're a non-union department head. And it will have a direct financial impact on this town about what their benefit package is. So it's kind of a very important issue. And to me, I'm just telling you my personal view is there should be one department head per department. I feel as though somewhere along the line, for you, I think it was before Brenda, it might have been before Mike, someone made a decision to call them a department head.
For benefits.
To give them extra benefits.
Yeah.
To give them department head benefits, which to me, I've never thought about it over all these years, is not right. There should be one department head per department.
Well, I think it's a good point, but it's not fixed yet. So I think we're going to be rewriting policies as part of this review that the town attorney, I believe, will be, you know, hopefully wrapping up soon. And yeah, I agree. We should look at everyone and, you know, what they're getting, because I had never looked at that policy until a few weeks ago, but you know, it's pretty outrageous. So
I think it's, I know it's long before you go, so I'm not, this has nothing to do with you, but I appreciate it. But I really think that, I think someone did this to help people in their department, in the first selectmen's department, which is obviously an elected position. And I just think it should be really looked at.
well, I'd also just like a lot of what we've been talking about recently is severance related stuff when people leave. So hopefully that won't be like an issue next week. Hopefully we got a little time to fix it. Yeah. I agree.
I'm just gonna add that I think to the point, I think that at some point, this is just me going back and looking kind of at what was the foundation of the budget and kind of the payrolls, just looking into payroll things, is that I think that department heads probably used to follow PETA, and the policy just may have been a codification of that. The way I look at some of the department heads in the first selectman's office is, well, if I think the non-union department head title was just more so to say that they're not union. And if they follow the PETA contract, then a lot of I think there's severance, but I also believe in PETA, there's a severance. So I don't think that would be impacted as much. Longevity in PETA, and then also, and then the only thing else is that there's steps in PETA. But I guess if an employee isn't, with all the other non-union employees in the town, I budget them, they're like designated as a non-union PETA. So the clerk has like 2 non-union THEA positions. So the fiscal impacts, I think, would be pretty similar as far as like in fiscal year 25, because if maybe one of these positions turns out to be a non-union PETA position, the structure of the contract is very similar, and fiscally, you won't be far off from where you are.
Well, at least the 2 positions in the first selectman's office that we're talking about, other than Mr. Gerber being the first selectman and being the department head, they can't be union positions. They can't be union positions because they're political positions.
No, but in other departments where we have non-union positions, they follow a contract. So
And I guess that's part of the question too, because Jim, I agree with you. Like to me, to model department head pay structure to the union contract, I think that's a question too. Like, I think it should be based on market and performance. I mean, and some of the department heads might be better off if it was done that way. So I guess the question is, and it's not just that, right? You read the policy and, you look at accumulated sick time and vacation time and all this stuff. I mean, somebody could take 4 months off, with all these policies that you add them up. The whole thing needs a refresh. So I agree with you. I think for budget purposes, the point is, right, we have a couple different buckets here. The bucket that happens to be in contingency is this amount here, which assumes it's a 2.75% increase. I'm assuming that because, Mr. Gerber, and tell us if we're wrong, you've just got to tell us that regardless of what policies you change, you think this is adequate to cover this upcoming year, because that's what we're voting on. So
I would like it to stay in contingency, have the flexibility over that.
Yeah.
But yeah, I don't think it should go into the budgeted salaries, but
But I think the direct question is, are you comfortable with the numbers here?
Yeah, no, and then you can take out the one for CFO.
Right, so that gives you a pot of $100,000, once we made the adjustment, to give out discretionary, because I think that was Ms. Kupchik's thing. She kind of said, I don't want to put it in the departments because it's early in the year and I don't know what the raises are going to be. And then they just turned out to be like 2.75%. So it's fine to leave it in contingency if you want, but you're just representing to us that you think this is the right amount.
Yeah, I believe it looks reasonable if you take out the two years.
My future boss is watching or will watch. Keep the increase.
Okay, Frank. Mr. Testani.
Sorry, John, I just want to clarify. So we've been talking about the chief fiscal officer. I think then Mr. Ruggiero mentioned earlier, the chief admin officer also has that projected increase and we don't have one. And we may
But
not.
we're going to talk about that topic separately because the open question there is, that has to be benchmarked too.
Okay, because we haven't established whether that, okay.
I would like to level set, I'm not sure, I don't think Kathleen is on tonight. If she had,
She's not, no, so but I just,
we're gonna talk about, maybe not tonight.
yeah, we'll get information about that before we vote. But
Yeah, okay.
So can I make one suggestion in terms of the schedule going forward? If this is to remain in contingency, I think the first column is relevant to get to the 3.816 million. Everything to the right is irrelevant. It's just 2.75% of the 3.8
bottom line
number. Taking into account the FICA as well. But we don't need to see the detail of the raises. It just adds to B, which is unnecessary.
Mr. Walsh?
These 2.75, that's not what's been given out every year to the department heads, right? Because some people have gotten more and some people have gotten less.
Well,
And it's been based, I thought, on performance.
I guess it depends on like what year you're looking at. So when I went back like around so I think 2021, I think there was a 0 because I think COVID hit. And then I think there was catch up in 2022 to basically combine 2 years. And I think department heads generally got a 4% increase. I could say that I think the direction in general has been to standardize this. Now, there's some department heads that actually have their own contract, and that bears a little bit of weight in this, but generally this is the general cost of living increase that.
Mr. Gerber has discretion on doing whatever he wants to, money that's in there. That'll be in that contingency, as long as he's involved. I think my thought is sometimes I look at those after that board of selectmen meeting, and everybody wasn't getting the same amount.
I think the captains are the only ones that I can think of in the last one that didn't get a similar amount. And that's to me, because I think the reason for that is they're part of the police department and I think they were.
Anyone in here who has a contract, that should be in the budget, in the
Yeah.
department, in my opinion.
Yeah.
There's no reason at all
Yeah, right.
to have that in contingency. And I think the point, because the reason this came up is because there was a FOIA training, I guess, and when I asked Ms. Carpenter to put a executive session on, she checked with the town attorney who said, why do you need an executive session? I said, we're going to discuss this, and that's where I got the guidance that, this stuff ultimately is not confidential, this part. This should be open to public disclosure. So I think it's good to have the conversation and have the transparency in here. And by putting it in contingency, it just forces us to then have another process to transfer it later. So, yeah, I'm not really sure. So if we're truly using this as a discretionary pot of money and we're going to differentiate between individuals based on performance, then that makes all the sense in the world. But if it's just a thing, then I'm not sure why we bother. Mr. Mattola?
No, I don't want to belabor this. But, a lot of municipalities do it, as you said, Frank, there's let's say a supervisor's union, And whatever increase they get through collective bargaining, the non-union department heads follow. So it can be done that way. It can also be done by ordinance. So or it could be done by, the discretion of the judgment. So there's a bunch of different ways to do it, and so I just wanted to throw that.
All right, and the registered voters considered to be department heads? I know they're part-time.
No, they're,
Officials.
their salary gets set, I forget by who, but they're not included.
We budget for it, so who sets their salary? I think, yeah.
Is it the Board of Selectmen?
Yeah.
Yeah, Board of Selectmen does.
First selectmen, it's a little bit selectmen.
All right.
Was there a vote to increase it?
I can't remember. No, no, not at all.
It's
It's a
staying
multi-year
the
thing.
same.
They're not involved.
They're not involved in the contingency.
They either funded it or not based on whether. Or selectmen pays the raise.
Yeah, it's not a multi-year. I just think that their rate was set at a point and there's been no discussion to increase it, so it hasn't been increased.
Madam Chairwoman, I noticed we haven't had this trend on the schedule.
I don't know. Some of the smaller departments just didn't get on the schedule. Nobody asked about it. FairTV wasn't either. Mr. Matola asked about it, so I added them. But if we have questions for them, they can be asked to provide additional information.
Okay.
There was a fairly robust discussion at the Board of Selectmen, though, so people can also refer to that. So to wrap this up, can I make a suggestion then? So Frank, on your schedule of adjustments that you're giving us, that has all these other things, can I suggest, if it's okay with everyone, that those individuals with contracts be moved into the departments, and that you add on the adjustment that's needed to prove up the contingency minus your new boss.
Like me.
Put the net so that we all know what that is when we vote. Okay. All right. So on a related note, we have the department head longevity analysis. This goes the opposite way of what I just said with contingency. So this was included in the individual departments based on a policy that is sort of under review at the moment. So we don't know whether that policy
Page 12 of the back.
So sorry, so page 12 of the posted backup. So let me just back up for the benefit of the public. So we had an issue that arose at our first regular meeting in March when we were asked to vote on department transfers covering severance and vacation payouts. And that discussion brought to light policy that was most recently signed by Ms. Kupchak, providing various benefits to town officials, including longevity increases for non-union departments. And many individuals were unaware of this, including members of this board, and I think some of the employees who were potentially entitled to those benefits. And had not previously gotten, as I understand. So the town included the longevity increases in the budget, in the departments, including catch-ups, correct? Were needed
Catch-ups for
retro.
No, retro is not included.
No, retro is not included. Okay, so no catch-ups. So, but we included the longevity increases in the budget. But we are awaiting an opinion from an attorney as to whether that policy was even legally authorized and whether those longevity increases are owed. So the purpose of this follow-up item here was in response to a question from the board, is to understand the cumulative amount of these increases and determine how they should be treated if we don't have an opinion from the town attorney prior to our vote. So if we have an opinion from the town attorney prior to our vote, we can decide, they may stay intact in the budgets. Maybe they get added to for catch-ups, I don't know. Or if we still don't know, we may elect to take them out of the budgets and put them in contingency. But so I guess the bottom line is we don't know where this is going to go until we get close, until we know when we're going to get that legal opinion. But just so everyone knows, on page 12, that is the amount that's been spread out in various departments in the budget. That's the, should I add up those two columns, or are those the 62 plus 30, or is it just 62 cumulatively?
So the due to longevity is 62 and
62.
yeah, that's the only part that's due to longevity.
Yes. Mr. Curley.
Thank you. So just to be clear, this is informational for us to understand what was in it, but this is not an adjustment. This is just to
It's
explain.
in the budget pages.
I just want to clarify. Okay. And then help me understand the mid-year adjustment. Why would there be a mid-year adjustment?
So like I said, when I was going over this page with the increases, on October 16th, the Board of Selectmen approved a cost of living adjustments for department heads. Last year, I would have had those cost of living adjustments in contingency. So this is essentially truing up what's in the FY25 budget for their salary is a true up to their current FY24.
So are you saying there's 92,000 in the budget pages right now for these two items?
Yes, 92,000 for these two, but only 62,000 for
longevity.
Yeah, but the 30,000 is just a true up. I mean, that's what they're making right now.
Yeah. And then on the longevity, what's the rationale between either a 3, 6, or 9%? Is that just based on?
So it was a five year was 3%, 10 years is another 3%, and 15 years is another 3%.
Ms. Leclerc?
So if they're currently making this, has this money been transferred from contingency to the different budgets yet?
In the budgets.
In the current budget?
That's why some of the raises look high in the budgets, yeah.
The current budget, I thought we did when we did, I remember we did a round of contingency transfers, and I believe that we dispersed this amount.
What, you mean the COLA number or the?
The COLA, no.
The COLA.
So in the current budget year, I think we did do a contingency transfer.
I don't think we did one after October 16th, did we? You can let us know.
I may have did it, but I may have done it before. Like I may have, because I know we did one for fire. I may have done it if I knew beforehand, so I have to go back.
So I think we have an open item on this one, and we'll try to get an update from the town attorney as to when we might hear about this. But I mean, it's not a ton of money, it's 62,000, but just so everyone knows what it amounts to. Mr. Walsh, did you have a question?
I just have it on the assumed longevity. Frank, explain to me again so let's just go down to the first one. It's down there. Community Economic Director.
Yeah.
9%. Why is that so large? Why is it 9%? Does it happen when you get to 5 and then you get to 10 and then you get to 15? We adding all those up like retroactively?
So originally when I looked at it, if they didn't get their longevity increases when they should have got them, then yes, you'd have to go back and retroactively if the policy is valid.
I don't know about that. I mean, my thought is, okay, it's a new policy. If that's a new policy.
Yeah,
If it's a new policy and you hit 15 years, I wasn't thinking that you're retroactively going back and making decisions.
That's what they're trying to figure out. This would pay them for that, but I think that,
That's a $65,000 question.
Yeah,
How long has this policy been in effect?
I know. I mean, it's just like, if it's a new policy, you're not trying to correct the wrongs from, 15, 20 years ago.
No, this,
I could say that this is complicated because I mean, I think there are older versions of that policy that included longevity. And I think that's the whole point of the legal review. This is my thinking with the retro piece is that there's a past adjustment in the accrued salaries line that I believe would be adequate to cover. And I think you can use the accruals for any retro on the balance sheet, but this would just cover whatever their increase would be. Now, I can say from doing a preliminary review, but I'm just being cautious of what I say because I've been working with the town attorney, but in the preliminary review that I found, I think that the people that may not have gotten them are actually the more recent. I think you're looking at more so when all this is said and done, maybe the 3%. Looking back, it looks like those people might have gotten them, but that has to all be confirmed. So I think on a risk wise, I don't think you have as much exposure on the people with these 9% numbers from a retro perspective, nor from a increase to next year's perspective. I think the risk really lies with the more recent people that would have received these. Because I think this kind of got a little bit lost in the weeds with the transitions that happen in human resources.
Rules there's usually been passed because of past policy.
There hasn't been past accruals related to this, but I believe in the audit report, there's a past adjustment, which is essentially set to say that we're over accrued by a little bit.
Okay.
And that we could, if we really needed to, I think that we could, I think this would only take a portion of whatever that over accrual.
Yeah, there's a bunch of people.
It's the over accrual. We haven't accrued for stuff based on any of these policies that the town attorney's investigating.
Yes.
Correct. Thank you.
Yeah, I mean, and we should move on. I mean, my thought was that, unless something definitive happens, we could move this $62,000 to contingency.
Yeah.
I would not want to take it out of the budget while this legal review is pending, because we might need to pay it. And then just kind of see what happens and, yeah. Mr. Jerry?
I know there's the legal review pending, but as of right now, when would this be paid?
If it's determined to be,
No, I mean, like, way the policy is written today, this is paid upon somebody leaving, correct?
Yeah.
They get it every year?
no longevity. So once you hit 5 years of service, 10 years of service, you get an extra bump in your raise for this percentage.
So on your anniversary date of 5, 10, or 15, you get a bump up of a 3% incremental raise.
Yes.
So why would we, unless someone's hitting an anniversary, why would we even put this in the budget?
Because these people may have hit their anniversaries but not received it. So that's what this whole question, these people may have hit that 5-year anniversary and not received it, and that's what's being researched.
We're protecting the budget, anticipating.
So mechanically, how it would work is, say I came to a resolution, like at the end of the week, right? We would update per what they should be paid with these longevity numbers. And then I would retro them to whatever, I would retroactively pay them what they should have been paid at whatever year they hit their longevity bump that they didn't get money for. This is just saying in the budget, I'm assuming that this is the worst case scenario of what we're gonna have to go back and do. It's not necessarily, it's not reflective of what's actually gonna happen.
This is one of the reasons why hired, look at their salary. Because you could have somebody who's been there 20 years, who has longevity bonus until 12%. The new person's not gonna be entitled to. And why in the past, oftentimes when we've hired somebody, potentially a little younger without the longevity, we've gone down in the salary. Not taking it right up to the top.
I think that's like an argument to the point that I think it's something that has to be looked at, because somebody that started, say, 20 years ago, also the pension would have been available. And you have the 401A now. So I think it needs to be a combination of, if there's a desire to continue to have a longevity policy, but then also, do you wanna from time to time look at the market rate and compare the benefits package and then have some kind of combination, but I don't think that's today.
Thank you.
Okay. All right, so good segue into the next topic, which is the COO, which we're actually not going to address this tonight, but we'll get information to the board. So the purpose of this follow-up was to get additional information about the COO position in the first selectman budget, including market comps. Again, this was in the budget. based on the former CAO salary plus a longevity bonus, which obviously doesn't make sense, but that was kind of a placeholder. We had asked Ms. Simpson if she could provide additional information similar to what she did with the CFO role. She wasn't able to be with us tonight, but she can get information to us and it will be distributed to the board and we can decide from there if any if members want any adjustment is warranted, then we can vote on that one. All right. So we've kept the chief waiting for a while, but welcome Chief McCarthy. The next item is fire. What Frank was able to do, I think everyone recalls that the posted budget was confusing because it didn't have, wasn't apples to apples because we had the 3-year break before in between the contract settlement. And so last year's numbers were very understated because 3 years worth of salary was sitting in contingency. So what Frank did was put together an analysis to try to just reflect the fire budget on an apples to apples basis so that we could ask questions on that basis and kind of take away that confusion. So that's on page 15 of the posted backup. And I don't know who wants to take this first. Frank, do you want to explain what you did here and then the chief can answer any questions on it?
Yeah, so
And Deputy Chief, sorry. Good to see you.
So backup starts on page 15. So really what you're gonna wanna really focus on is the 3 columns starting from the left are gonna give you the objects and the description of the accounts that they do. And then towards the middle, you're gonna see FY24 last year in the budget. What I have labeled as column B, contingency, is the amount of money I held in contingency for that object. So the true budget number for FY24 is gonna be what I've called column A plus column B. So that's what the number would have been if you included the contingency in that line item. And then the percent change is comparing, there's a misnomer here. It says 25 approved, but it's really 25 proposed versus the 24 approved with the contingency. The percent changes are reflecting kind of your apples to apples percent changes.
It's the 7.27%.
Correct, yeah.
So just to be clear, so obviously we already went through this budget, so anything that's grayed out on here has not changed. So it's only the numbers that are not grayed out where we've kind of trued up last year to reflect what was in contingency. Those are here for the board to look at, and we can address any questions on those items. Mr. Testani?
I just have a quick, I know we talked about this quite a bit, Chief and Deputy Chief, thanks guys for coming. So the lieutenants, which line was that the regular payroll to 7, right?
Yes, 8 in regular payroll. Those new positions.
So the 8.
The delta. So that's the
Sorry.
delta of $20,000 per head times 8. It would be.
And Frank, I'm just curious, I know that obviously you've got more in there for the contingency. Was that on the settlement of the contract, or why is there more than? The 20,000 times 8 is in 9.6 million, right? So, or is that just overall increases, or what makes
The 9.6 million is what I held based on the expected settlement of the contract.
That's what I'm asking. Okay,
Yeah, it includes what I would have held.
thank you.
Ms. Ruggiero?
Hi. Last week I had asked about what the cost is of adding the lieutenant to having a lieutenant on each of the trucks. And you had said it was 160,000 incremental expense. And I'm not following how that number can make sense, because if you're adding a full head,
So we are taking a firefighter position, taking a lieutenant's position. So the cost per head is
20,000.
differential between top step firefighter, top step lieutenant.
So you're not adding just a whole other
It comes-
body, you're just making that person a lieutenant. Okay. Thank you.
Thank you, Mr. Chair. Other questions? Mr. Walsh. Maybe the chief can answer.
Chief, education and memberships, what does that consist of? Do you know any of your,
So I did,
go to, take classes,
yes,
like try to get a better
So-
degree that's in your area, things like that?
I provided to the chairwoman a list of each of the accounts.
And I emailed that to everyone.
So education and membership includes the tuition for the fire academy. So when we send recruits to the fire academy, and we may send 4 or 6 in a fiscal year, the cost of the academy is $7,000 a head roughly in tuition for the academy. In addition to that, we have a contractual relationship or contract service that's in the collective bargaining agreement for the YMCA memberships. We buy fire code up to a subscription service. We have contractual college incentive payments and specialized training. Those are the general categories that is covered by education and memberships.
How much does the YMCA cost?
$25,000 a year.
7,000. And then the tuitions to go to fire academy, what is that for?
So when we hire a new firefighter, they go to the fire academy for 15 weeks. It's a residential program, and they come out of that program a certified firefighter, a tailboard ready or jump seat ready firefighter.
I like the police department a little bit, like the way
The fee is established by the fire academy, and it has crept up because they haven't kept current with costs. So we're somewhere around, I think, $7,500 for tuition that gets paid directly from the town of Fairfield to the state of Connecticut Fire Academy for tuition for each member that goes to the academy.
Okay, so we talked about that. We talked about the YMCA. What was the other section?
So we have subscription service for fire code. So all of the fire code standards, and there's a contractual college incentive. So firefighters are eligible to get 100% reimbursement for college degrees, for college courses leading to a degree. And lastly, specialized training if we send people training for a specialized certification.
Okay. So how much has that been in the last year for the 24 budget?
So the total,
Specialized training.
so I think that you can look and speak to the issue of the total expenditure for that line.
I don't have a, well, I can tell you what it is.
Yeah.
Your
so-
data, you're talking about in that particular, I don't have the breakdown. That's what I figured for that.
Okay, you get me that. So how much of your training is in your education budget, education and memberships budget? And I'm not talking about new firefighters, excuse me, or how much of your training? Mr. Becker made a statement during your budget that some of your training for your firefighters would actually be in your education budget.
So the majority of the training expense is in the overtime budget. When we pay overtime to
Yeah.
have people attend class.
So basically, none of it is.
There's some other courses, the EMT courses that we run that would require all our firefighters have to be EMTs. So each year we have to do 20 hours of research. So that's 2 days, each year for each firefighter. So it winds up costing, it's about $8,000 to have a person come in and teach us.
Somebody who's certified, come in and teach all the
So
firefighters.
that's another thing that's in there,
Okay,
the training expense.
that $8,000 is in there. But that's just for EMT recertification. Okay, anything else in there?
So that is where, for out-of-pocket expenses, non-overtime expenses, that's where we are paid.
Okay. All right. And Frank, I'd asked for, I'd asked for the invoices. You had said, maybe I can get you the munis numbers. Do we have those?
Yeah, I actually, and I'll have to include it as additional supplemental backup, but I have for educational memberships, I think regarding, I have the list for, I think it's FY '24 for what's been paid out in the vendors for that list that I could give out.
Okay. Now, contingency within your department, notice that, I guess these munis pages, whatever, and I see all the changes from the contingency. So every year that we do the contingency, we put in holiday pay as part of the amount that goes in.
Yeah, there's a, in the contingency sheet, I show all the overtime numbers as one line, but each line you see here is what I actually broke out.
Right. I have no further, thank you.
Walsh, Mr. Testani.
I just have a couple quick ones just for my own clarification. So on page 16, maybe this may be more of a Frank question, but what is the capital outlay line of 127,700? I'm a little confused by that because number one, it says 24 approved 180, 24 approved plus contingency it's proposed. Proposed 25 is the increase for the capital outlay. So what is that number? Frank, down the bottom of page 16. 127,700. I don't know.
That's the increase.
Yeah, that's just the increase.
That's the difference.
Yeah, we were trying to, remember the budget page showed an 18% increase? This is trying to say, what's the real increase if you layer the actual retros in last year? So that's a true increase on the,
On the capital outlay line?
yes, that's a true increase. And we talked about that.
So if you add up 180 and 127, you come up to 307?
Yes.
Okay, thank you. And I'm sorry, one more. On the other discretionary items, and I think you referenced this, Chief, that adds up to the 233, 255, and those were some of the things you were discussing. Toward the bottom of page 16, after capital outlay, the lieutenant promotions that you talked about with me and Mr. Jerriel, the other discretionary items are what exactly?
It's just kind of like in all other bucket.
Well,
Someone up.
Every increase that's
So they're
not,
not, it's non-salary, non-overtime,
That's,
non-capital,
that's what you were talking about.
everything else.
I got you.
It wasn't identified in the Because we were trying, if it wasn't identified in these other breakouts,
Yeah.
it was grouped there and that's the net, someone up, someone down.
Right.
That's why it's sort of the other discretionary, because the idea was to build out year over year. If you didn't factor in, what you think year over year. And that's 7.27. One thing to note, just on the top line, the contingency that had been carried didn't factor for the 4 additional firefighters, which was part of the arbitration. So that was part of the reason for the larger, the 9.6 going to the 10.2. So that wasn't factored in. They protected for the salary increases, but not the headcount increases. That's completely separate. Salary.
great. Any other questions on this? Mr. Stark?
Yeah, back to the main budget, training relief is pay for what exactly?
So when we have firefighters that we send to pump class, ladder operator class, we would pay them overtime for their time that they are not working and relieve them from duty, and we have to pay a replacement. So it's that replacement cost.
Okay, so this might be for Frank. In that extra backup you gave us, page 57. It's fire year-to-date budget. It shows training relief, but it doesn't really show any training. So is that like category some business? Or are they not, do they not go in sync? Or is some of the training free or?
I'm sorry, Kevin, what page are you on?
57 of the backup.
I mean, 16.
No, he's talking about the other supplemental.
Fire year-to-date budget report. I just want to understand how that, The two go together, the training expense and the training relief expense.
Can you just clarify your question? I'm sorry.
Look at that page, it shows training relief, right? You can see it, about 10 lines down. It's, $272,000.
Yeah.
And then training is only like $45,000. I think the number, it's just, I'm just wondering if.
So portions of that training, the smaller training number
Yeah.
is one that we negotiated when we established this facility. It was originally, the first year was $25,000 to operate this facility. The town's share of overhead for the fire school building. And it was limited to all of the utilities that we pay for the building. That number has crept up over the years as the utility costs have increased. That is a separate, it's a misnomer the way it's described as training. Relates to that portion of it.
In this year's budget, I guess it's, in this year's budget, it's about a 401 training relief to training. I guess, okay, it's on the level. But those two numbers seem commensurate to you, that the amount of training relief that's being paid is.
So I think that we talked at the last meeting of the significant challenges ahead of us as a department and as a community with the additional staff that we're bringing, newer officers that will require training, the OSHA demands that will be incumbent upon the department. Essentially, send them into an environment, be trained for that environment. These are typically low frequency, high hazard environments, responses. But if we're going to say that we're responding to a swift water rescue, someone falls into the water at Santa Maria Dam, and we're going to get them out, we have to make sure that we're training our personnel for that scenario. So we have a significant headwind for training going forward, and we're anticipating all of those elements that have produced the increase.
Another question from the lieutenants. Have some of these people been promoted already?
No, they haven't. It's pending resolution of the budget.
Okay. Not that I'm thinking this way, but I would like to understand what the ramifications be if you didn't approve. So I know there's the safety argument, but beyond that, like rank and file morale, tell me more about what the ramifications.
There has been an expectation that the direction the department and town is going to support. Certainly there is a good justification, as I spoke at our last meeting, for why we want someone to be a certified fire officer. If you're commanding a company of personnel on a roof and doing a search and rescue up on the highway by themselves, at an EMS call by themselves, that it's an appropriate level of supervision. It's a working foreman, essentially, in that crew. They are doing the work now. I think it was recognized by the Board of Fire Commissioners at their last meeting that, hey, these folks are doing the work of an officer right now, and they should be compensated for the work of an officer. So all of the parts and pieces, there's an expectation that it's going there. Quite honestly, it would be a gut punch. The feeling, that's what the reaction would be.
That's important.
It's important to a lot of people in the department, everybody in this.
And so these people know who they are already too.
They're on an established promotional list. They have competed for it and qualified for to appear on a list. So they will be hired in rank order off that list.
Thanks.
Thank you, Mr. Stark.
I just have a quick
Yes.
follow-up to that, and I know we talked about it, Chief, just to get to Mr. Stark's question. So like the police, are the people being considered for these lieutenant positions given a separate test, or have they already been given a test? They've already been given a test.
Give a test every 2 years and,
Make it to the rank of lieutenant.
and for the assistant chief. So in March of every year, we run a test. So the next test was scheduled for, every 2 years. The next scheduled test will be March of 2025. We refresh the list each time. So if you're on a list and you don't get promoted, you have to now compete against a whole nother candidates or competitors to get back on the list.
So safe to say there's more than 8 on that list?
There's only 7 on that list.
So you don't have enough to fill the
Have to-
lieutenants to refresh it. When you say refresh it, does that mean a new test or?
And we will work with the administration and HR department and negotiate the impact with the union to make a determination when that occurs.
Unless the town approves 7, right? Because in essence, you can only promote 7.
So we can promote 8.
Under
There's a process in absence of a promotional list, because the list will be expired after you use 7.
It's next year though, right? 1 more year?
If the Board of Finance and the RTM approves the promotions, we will use the existing list to promote 7 off of that list. There is contract provision that says in the absence of a list, by seniority, the position can be filled on a provisional basis, and it will be filled on a provisional basis until the next test.
No, I understand. I'm kind of going off what Mr. Stark's line of question a little bit, because my thinking is if we have 7 ready to be promoted now, let's say, that's on the list, and the Board of Finance or Board, whatever, but let's just say for the sake of argument, we approve instead of 8, we approve 7, right?
I would discourage you from doing that.
Oh, and you're saying that because of the action that it would have within the personnel, am I right in saying that?
If we're going to take the step to put
You want all
provision on 2 trucks, on, 8 positions on 2 trucks, well, 2 per ship, then we should move in that direction. We have a mechanism to fill that 8th position.
Okay.
And I think that it will benefit the department to do it that way and have all 8 positions filled. One will be a provisional, but we'll have those positions.
Okay, thanks, Chief. Appreciate the clarification. Thank you.
Thank you, Mr. Justani. Mr. Walsh?
I just want to follow up with something you said earlier. Thank you for answering all my lieutenant questions last meeting. Talking about going up on the highway and going up onto roofs. I presume you're talking about fires when that happens. I've never seen, maybe, I mean, I'm wrong. Anytime I see you guys up on the highway, it's a very dangerous situation. It's crazy, actually. There's always multiple, like 3, 4. Right, so you have a whole team of these?
So we have a response protocol that sends 1 truck up, 1 vehicle up, solely for the purpose of blocking the emergency scene. We talked about the accident when we got struck. So we are sending a pumper to handle the fire. We're sending a rescue truck to handle the vehicle extrication. We're sending a blocking vehicle and sending a command car. You'll see 4 red vehicles up there. But let me just say, one of the challenges, and we shared an email, myself and the training director and the deputy today. There was a call at Sacred Heart, and 3 went up to Sacred Heart. There was another call at Cambridge Manor, and Engine 2 now is responding across town to respond to Cambridge Manor, and think of the response time from Jennings Road to get to Cambridge Manor. And 3 clears Sacred Heart and starts to head back. There is, at the same time, this is going on within the same, hours elapsed time, a automatic fire alarm at Sacred Heart Now, and the tree's going up. Now we have to get a ladder 2 and engine 1 from Reef Road to go to Sacred Heart. So this happens, and it's just today's experience, you know, at 6 o'clock tonight, you know, we had 3 different calls that people are scrambling from around town, long response times. And if there was a call on I-95, and this gets back to my point that I made last week, the rescue from Reef Road is going up to I-95 by themselves until help arrives. And that right now is 3 firefighters without supervision. And this scenario is occurring more frequently. And it is one of the reasons why I think that we need to embrace some changes in the deployment of the Fairfield Fire Department, how we staff, because it is one, not good response time, and an inadequate number of people end up at the scene on that initial alarm. So our first effort at this is to provide lieutenants at a compared to new headcount is a less expensive option to start to address that.
But if there's a fire at someone's house or they're always going to be an assistant chief flying there in one of those SUVs that I see.
If he's not at another call.
Not another call. So there could be a situation where residential fire going on. Fire coming out all of us. And you just got that.
Yeah, initially, I mean, if people are at others, you know, we have our plan is going to send 3 engines, a rescue, a ladder truck, and the command car. If any one of those is at another call, then a further away asset is going to be responding. If the assistant chief is at a call that he can't break away from, then we'll call in. We have callback protocols to bring in off-duty people, but that it means someone's driving from home or wherever they may be to come to work, not an instantaneous response. Thank you.
Thank you. All right.
Thank you.
Another easy day today, huh, Chief?
Another easy day. So,
Should we get pizza? No.
Thank you, Chief.
Thank you.
Thank you.
All right. Thank you. Thank you for being here again.
My pleasure.
Appreciate it. All right. We were joking that if we were here past 9:30, we were going to have pizza brought in. But
I offered.
all right, so, okay, we only have a couple things left. So the next question, or the next follow-up item, this was Fairfield County Dispatch, the revenue calculation. I think we actually got this answered during the last meeting, but we had asked, Mr. Walsh had asked, I had asked, Frank could provide the actual calculation so that we could look at it. The reason for this was to just make sure that we were all comfortable with the split between the funding that's provided by Fairfield versus the other participating communities. So that is on page 15 of the posted backup.
15?
Oh, no, not 15, sorry, 17, 15, 17. So I will turn this over to you, Frank.
Provided 2 pages here. Page 17 is an updated version. Page 18 is the original proposed. The reason why I did an updated version, you'll see from the proposed adjustments that there were some changes to the FCRD budget, but just the general flow of this, and I can go over any questions, is start off with your expenses, and then you net out revenues from other sources that include state grants, and then there's a portion from New Canaan here. After you net out that revenue, you get a net cost. That net cost is divided 67% Fairfield, 33%. And if you look at those, now, I know there was a question of, fortunately, the percent increase should be the same for Fairfield and Westport. It would be a little bit different this year also, because when I did look at FY '24, instead of using 67% and 33%, I used 2/3, a third. So that creates just a little bit of a rounding error also. But in FY '25 budget, the important thing to know is the net cost, about $3.7 million, is 67% Fairfield and 33% Westport. And the way it flowed, and I show the shares for Fairfield and Westport, and then I also show how it appears in the budget. And the bottom right two numbers, the 80,991 and the 39,892, that's going to foot to the proposed adjustments. That's at part of the first pages in the backup CRD, related to various adjustments for insurance and pension and so on. And I can take any questions about it.
Mr. Ritola.
Real quick, I don't understand the East End annual service fee.
That was,
So that was the revenue that we had been assuming moving forward that I had chose to take out this year. Because I didn't think
put it in the budget last year, but it didn't happen.
Oh,
Easton didn't happen.
Easton's not part of it.
Easton's not part of it.
Thanks.
Mr. Curley.
So just want to make sure I heard you correctly, so I'm going to regurgitate it with my interpretation, so I heard it correctly. So I look at page 259 of the budget book, which talks about the revenue. Previous proposed revenue was 3.95944, split into the three categories. If I'm hearing you correctly, the 1250 832 is going to increase by 39,000 and change up to 1290. I'm looking at the backup of page 17 today. The state ECC subsidy of 327 is unchanged. The revenue from Fairfield, 2381, will increase to 2462 and change for a total increase of 120.83. Okay. Right. So that's the revenue side. And then on the expense side, only the town of Fairfield portion hits. It's spread over various line items, but the total increase on the expense side for related to Fairfield is the 8991. Right.
In the general fund, you're talking.
Yes.
Yes.
So that, but if we do take into consideration that 39,892 that is being picked up by Westport, that's what nets it to zero. Okay, I'm with you. Thank you.
Yes, so this board, so we don't vote on the budget per se, we vote on the line item that
It's us.
So the adjustment that we will see is the 80,991. We will vote on that as an increase, again, driven by the pension number primarily.
Yeah.
Okay. Questions, other questions on this? Esposito here, made him sit there for nothing. Thank you.
Yeah.
Thank you.
Sorry about that. I hope the rest of this was fascinating for you.
Very interesting, and thank you.
Or that you were multitasking, doing something fun, but thank you.
Thank you.
All right. Okay, so we can move on. All right, so the next thing, and I'm happy to take some input here on the board, but we put tax collection rates on here as a follow-up item for the following reasons. So when the Board of Selectmen voted on the budget, they added, I think, over 200,000 expenses. I think it was 221,000. But when they did that, the mill rate that was communicated to the public didn't really change from the first selectman's proposed budget because the Board of Selectmen made an assumption those extra expenses would be offset by a higher property tax collection. So for members of the public who haven't followed this process in the past, this board is responsible for setting the actual mill rate each May. And yes, it's based on the budget that ultimately is approved by the RTM, but in setting the mill rate, we also take into consideration new information that might come to light through that day, and we make an assumption about uncollectible taxes, or inversely, the tax collection rate. So as I said, the Board of Selectmen voted to change the tax collection rate that was originally proposed in the first selectmen's budget. And the tax collection rate they assumed, which was, I believe, 99.07%. Is that right?
Yes.
Was resulted in the mill rate that was communicated to the public. It's a 1.8% increase from last year. And that action by the Board of Selectmen to offset budget changes through a change in the tax collection assumption is not unprecedented. Our previous Board of Selectmen did the same thing at least once. But this time, the tax collection rate utilized to get to the 1.8% is higher than anything this board has historically approved in setting the mill rate. So I thought it was worth a discussion to understand how the board feels about that. Because when we do vote on this budget, we are going to communicate a mill rate to the public. And we're not voting on anything about this tonight. We're not going to vote when we vote on the budget, but we are going to communicate to the public a mill rate based on some assumption on collection rate. And so I just wanted board members' thoughts, if people are okay with communicating to the public based on that 99.07. I just want to hear that. If people have concerns about that, I just think we should give our budget director guidance on how to do it on the night we vote, because I don't want to be misleading to the public and use a tax collection rate that we might later lower. When we vote on it. So just throwing that out there for discussion. And maybe quickly before we have the discussion, Frank can just take us through the budgeted and actual collection rates historically so we can see what the heck we're talking about here. And that's on page 19 of the posted backup.
Yeah, so essentially what I did here was I asked the tax collector to provide a list of actual collection rates from 2009 to 2023. And then I went through the approved budgets that I had access to, which is through 2014, to see what the budgeted collection rate is. And traditionally, it's been assumed to be a little bit lower than actual. What was the 99.07 is pretty close to the 2023 actual. I did speak with Dave Kay in the tax collector's office, and he says we're on track to achieve the same numbers that we did in 2023. But of course, there's more of the year to transpire, so that's just a projection from him at this point. But if there's any questions about some of these numbers, I'd be happy to answer.
Okay. Mr. Rotolo?
So it's the 99.07 is just average of the last 3 years, right?
Yeah, a little less.
Yeah, it's also an average. You have to take out 2020, 1920, that was the deferment year.
So it's 22, 23, 21, 20. So take out 2021 or 1920?
1920.
1920, so it's
It's also about the average. That's correct.
Yeah, and I'd also refer everyone to the budget. I mean, I
Yeah.
think we budgeted,
we've always budgeted a little.
yeah, we haven't gone to the edge where we budgeted, so that's there also. Does anyone else have comments for us, Ms. Ruggiero?
So the number that, the 9907, that's the assumption we're making in this year's budget, that we're gonna have a 99.07 collection.
That was the assumption that the Board of Selectmen made when they voted. So the original the first Selectmen's original proposed budget was
98.99, I think.
5-year average.
Okay.
5-year average?
So
Versus 3.
right now, this budget that we're reviewing has a collection rate of 99.07.
That's what the assumption is.
That's what the current mill rate that's been communicated to the public is based on.
The way this board sets it, so it's a proposal.
Yeah,
it's
And the
just-
mill rate assumptions are
But
based
it's
on.
important because when we vote, this number gets picked up, talked about, the public's sort of gets set in the public's mind.
So we're gonna go from 98.9 to 99.07. Am I understanding that correctly?
That's what the Board of Selectmen proposed, but
I
it's.
mean, if we accept this budget.
Budget.
No, I know it's up to us, but right now, this budget includes that number, so we'd be going from 98.9 to 9907, correct?
Your assumption would, but you vote on the mill rate separate.
She's talking,
Yeah.
the budget, what we used to set the mill rate, yeah.
For set, if you went there, you.
Last step.
Mr. Penley?
Looking at the actuals and I guess taking out 19 and 20, it looks like it's definitely trended up. Is there anything that's happened that make tax collection marginally more effective, like for the past 3 years, or is this just not attributable to anything?
A lot of new people. The tax collector can affirm this, but essentially, if I've understood it from him, you had a lot of new people, as the first selectman said, moving to the community. And I think also the amount of any people that maybe weren't paying and sold their house and took advantage of the market. You have some of that going on, and I think more people just pay through their escrow, through an escrow account, and so that just leads to a higher collection rate. Really the answer that I've gotten from him.
Demographic, socioeconomic.
There had been one really large outstanding tax payment that was collected about a year ago. Did that have an effect on the collection rate?
No, that goes into the prior year
That's just
number.
the prior year.
This is just the current year. Yeah.
I mean, I think it has to do with the escrows to some degree. Younger people that are buying the $1 million house here, what I hear from them, do not have 20%. They're putting that like 5%. So there's no possibility that they won't have to ask. Whereas before, 20 years ago, many people put down 20%. It's more standard. They don't care about paying. They have higher incomes. They're willing to pay EMI insurance. There's no way they can wait. They have 20%. It's now $200,000. Oh, I don't know. Very aggressive. But our tax collector thinks that they're gonna hold. It's his responsibility. And if the board of selectmen thinks that they're gonna hold, I don't know, I'll think about
Well,
it.
it's our I mean,
What? I mean,
ultimately,
it's
it's,
about
yeah.
expenses, we can pop it up.
Yeah, I mean, listen,
Ignite and see what happens.
ultimately, we can take all that in, but we make the final judgment on this, so it's up to us. Mr. Curley?
Yeah, this is a request actually for you, Frank. We can do this, but I don't know if you already have it handy, or if you don't, maybe you can put it together so everyone can have it, but it would be helpful, I think, if we just had a scale, basically showed for every 10 basis points of movement in this collection rate, what does that translate into dollars? And what does that translate as a second step into change in mill rate? So I think that would be really handy for this board, especially as we get to a point where we're ready to vote on the budget, to understand the potential implications.
All right.
I'll tell you, I'm in a position, I don't want to be the one that raises taxes. Other people make decisions that we don't want, pay for the expenses that we just added on. I don't want to take it. They don't make it.
Well,
And I'm telling you, I just don't.
I don't either, but let me,
That's just not gonna be who I am.
no, listen, I mean, we all have our own, I don't either. I think that if you raise expenses, then you should raise the mill rate to go along with it.
Yes.
So just say that right out. However, we also have this other sheet here, and we've got some other adjustments that are coming from lower insurance and pension and other stuff. So once all these things get factored in, all else being equal, they would offset what the Board of Selectmen did. So if we were to, and I'm just throwing this out there in theory, if we were to use the slightly more conservative assumption that was in the first Selectmen's original budget, with all this other stuff we've got here, it would not increase the mill rate. Yeah.
8.99.
Yeah. So if anybody's worried about being a bad guy, you won't be a bad guy because there's some stuff here. But I think, my opinion, I just think we should do the right thing, and I think we should what we should communicate to the public is what we believe will be comfortable actually voting on. And I know there's a tendency to want to be slightly conservative because God knows what can happen. So, you know, we can do whatever everyone's comfortable with, but I think that what we communicate that night is important. So is everybody comfortable? Mary?
I just wanted to know, is there a history about the 5-year average, 3-year average? Have we historically done one or the other?
I think in the past few years, this is just the past few years, I think we've looked more so at the average.
3 years?
3 or 5.
No.
3 or 5.
Or which average we've used, I can't count.
You don't want to use the 5 because.
Well, we've excluded the firm, we've taken, yeah.
Historically dictated one, sometimes a little more aggressive or in each direction based on all sorts of different factors.
Just listen, I'm just gonna be, just to throw this out there, guys. You know, we also have the stuff that we don't talk about in that calculation. There's an assumption about senior and disabled tax relief. Who knows? That could be a little bit different. You know, there's delinquent taxes. You know, I prefer to be a little more conservative because I think if you're so close to the edge, any of these other little things could go in the other direction. So that's just my personal opinion. But I think a consensus would be helpful. And I appreciate Jim's comment because I get it about not wanting to sort of take responsibility for the bad news, but there are adjustments that more than offset that. So everybody should just focus on that. And Frank's gonna update this. And that's before anybody ever decided to do anything. You know, I don't know what the feeling was on interest expense or investment income or anything else. But the adjustments to date, and let me make sure I have this right. So what Frank's got here to date is you've got just on this sheet alone. This is actually the next item on. This is the sheet that lists all the kind of corrections to the budget that have been identified thus far.
Page 3.
It's page 3.
Page 3.
Yeah, it's right at the top. So this, the adjustments here are a positive 250, right?
Yes.
So they more than offset Board of Selectmen adjustments, and that's before anything else that this board takes action on. So, you know, if all we did on budget night was pass these suggested adjustments and use the old mill rate, we'd still be the same or slightly lower. So everyone knows.
We might also not have the fees anymore.
Yeah, that's saying before we do anything else.
$3,000.
Yeah, before we do anything else. Yeah, so that's why I'm saying the collection rate, I'd like to. Well, I'd like to know, because when we vote on this, and I don't know if we're gonna meet again, when we vote on this, Frank's gonna have his numbers handy and we're gonna be ready to, the minute we vote, we're gonna ask him to communicate what the mill rate is. So I just was hoping to get a sense from everyone. Mr. Conley?
Yeah, so just clear me up since I'm new to this. So you're saying with the on page 3, with the items under the Board of Finance changes, doing nothing on the same collection rate, we could actually bring it back down to the old 98. Okay, so then the whole question of this collection rate is just, you're saying it's sort of on principle, if you're gonna increase the budget, then you need to take the taxes off somewhere.
Yeah, I'm saying, so the Board of Selectmen increased expenses 239, that just the, I'm calling correction/new information, takes it down by 250, so it kind of wipes that out.
Yeah.
So if we were to go back to the original collection rate that the first selectmen proposed, we would still be at 1.8 or slightly lower. Again, before anything else that we.
1.8 increase to the mill rate.
What?
1.8 increase to the mill.
If you're asking for a sense of the body, I prefer to be more conservative on the collection
Okay,
rate.
can I take a sense of the body? Who would prefer to have the original tax collection rate?
Around there.
Yeah.
Yeah,
Okay.
give or take.
All right, roughly, okay. Okay,
Is it unanimous?
I think it was.
okay. So what we'll do, so Frank, for purposes of the Yeah, so, and we don't vote on that because that's a calculation that happens later, but for purposes of communicating the mill rate when we vote, we'll use the original. Okay, perfect. Thank you.
No, she's sleeping.
What's that?
Now you're gonna sleep.
Having a piece. All right, so, and so we already I think we already talked about this proposed Board of Finance adjustments for updated information.
Yep.
All right, so the next item on the agenda is item 4. And I introduced this at the beginning of the meeting. So this has to do with the portion of the contingency budget that relates to open negotiations on collective bargaining agreements. So I'll go ahead and put forth the motion that we move to executive session to have that discussion. Second, Mr. Nicola, all in favor? Okay, it is unanimous.